Hey trader, Stephen Quitzel here. It is Friday, July the 19th. I want to do a educational webinar, kind of pick a topic that I think is very, very good. One of my best ideas instead of doing the usual market update webinar. So, I want to talk about a long-term strategy that I really came up with, or should I say started implementing about a year ago. And so far, I think it's worked very well for me on this one stock. Now, before we get started, full disclosure, I do own this stock, PAGS. This is going to be our case study, okay? I do own some shares. I'm going to talk about that. This is not a recommendation for you to go out and buy any shares at all. As always, make your own decisions, but this is just a great case study. So, I'm going to talk about a strategy that involves swing trading around your long-term positions or around your long-term ideas. I like to think about it as, this is Warren Buffett's strategy on steroids. And, the way I look at it is, if you swing trade around a long-term position and you are reinvesting your gains, you're keeping your shares in the stock. Let's say you're reinvesting, 10 shares and you own 100 for the year. Well, you just swing traded, an extra 10% into your position. That's like paying yourself a 10% dividend. Now, you can do 20%, you can do 30%, but I'm going to walk you through, step by step, my logic behind this strategy. And I've been doing it about a year for this one stock. And I want to show you how it's gone, the good, the bad, the ugly. There's been a lot of good as of lately, but I did have to sit through some nastiness during a bear market. So, the one thing about picking a stock for long term is don't forget the long term part. I always tell people, if you have a long term strategy, don't forget the long term part, and don't forget, don't get shaken out in a bear market or whatever the case is, or whenever that strategy has a drawdown period, because that's the time that you need to be sticking with it. Now, when you hold a stock forever, when you hold a stock for 10, 15 years, a lot can happen. It can go to the moon. It can go completely bust. So you have that single stock risk. But, I was inspired, read a couple Warren Buffett books, so I said, okay, I want to pick one or two stocks where I believe just has massive growth potential over the next 15 years. And I picked PAGS, P-A-G-S, as one of them. And this company, and the logic was incredibly simple. I could explain this to a 7-year-old. The logic was simple. So this is a Brazilian payment processing company, right? Kind of like the Square of Brazil, right? At the time, only about a year ago, only about 5% of all Brazilian payments were done electronically, right? Versus, I don't know what the numbers in the U.S., but to me, I'm like, okay, you have an emerging economy. There's going to be a lot of growth over the next 10, 20 years. But, if you have 95% of the economy using cash, there's a lot of upside for electronic payments. So this company allows, here, I'll actually kind of take you to the website. So just kind of a quick background, this company has these small handheld devices that allow, companies like you've seen, the little square that you could plug in your cell phone, has handheld devices that allow small and medium-sized companies to take debit cards, to take electronic payments. So my concept for my long-term idea was incredibly simply, I have an emerging economy, and I have, it has a lot of potential growth. Again, I'm not trying to sell you. This is my idea. Get your own. I'm just trying to give you a background story. So I said, okay, if I want to have a long-term position, you really want to start small, right? And when I say start small, a few $1,000, kind of nibble in. So I really like to study IPO. So I had my eye on this IPO, and I read the background story. I read the idea that there's just so much opportunity for growth in digital payments in Brazil. And this was a leading company along with Warren Buffett's StoneCo, which is, now an IPO as well. So I said, okay, I'm going to wait for this stock to give me a signal, and I'm going to slowly start to dollar cost average in. So it popped on earning, right? It was in an IPO downtrend, right? From 40 to 25, right? There's a clear downtrend right here. I can draw the trend line. And then it popped big on earnings. It was up like 14%. You could see the volume bar. That is a signal, even though I knew it would come back and fill that gap, that is a signal enough to me to initiate a starter position, okay? So I started here, I bought 68 shares, and I'm talking small, like a couple $1,000, right? Because if you have a 15-year strategy, and I'm going to show you how starting with a few $1,000, you know, that small acorn can turn into a giant oak. We're going to talk about that, but, you know, started with something where if something bad happened, I'm not going to get emotional about it, okay? You know, $3,000-$5,000. I'm not going to get emotional about that. Maybe you will, so maybe you start smaller. So then, you know, it came back, filled the gap, and then it started to come back. You know, it started to show me signs that it was basing, you know, at the bottoming pattern. So a lot of times when I see a basing, right, you can draw a rectangle, and then you can kind of see like the deep cut. Then it starts to climb. It starts to pick off these pivots on the right side. So I bought some more right here. And then I had another gap up right here. I bought some more right here. At this point in time, I own 175 shares. I'm invested, you know, $4,000 or $5,000. I'm like, okay, I feel pretty good about this. You know, that's about all I initially wanted to put into it. Obviously, I could put in more, but let's just see what happens, okay? So this was back in October of 2018. Well, I think we all know what happened in the fourth quarter, right? Bad things happened. So, but again, because I initially had my starter position, I let it go. I wasn't that emotional. I knew I could sit through it. So bear market happened. This thing got cut 45%. So, you know, kind of that gut check. Well, then I had the idea of, okay, why don't I just swing trade around this position? And what that means is swing trade. I could buy 100 shares, and if I make 10% of PAGs, and then if I can make 10%, well, I would just, you know, keep 10 shares in, and then I would sell the 90. That way it's like paying myself a 10% dividend, right? That way, and that can just continue to compound, and I can do that for several years. So I was like, well, that sounds like a good idea. And I'm 1 year in, by the way. I'm not even a full year in. So this was the bottom. This was the end of 2018. So this was kind of, look at this as my initial starter position. And this was the bottom of 2018, and I was getting signals, you know, that the market had bottomed. So I went ahead and I was like, okay, I'm going to put 100 shares, simple stop loss under a new low, right? If I get sold out, then I get sold out, right? Then I'll let the cash in my account take the loss and not my stock, if that makes sense. So I bought 100 shares, and, you know, with the idea of, okay, if this moves up against, if this stock, I bought 100 shares, if it moves above the 20-day EMA, that's my new stop. If it moves above the 50-day EMA, that's my new stop. Well, right here, it broke both in the same day. So I sold 87 shares. So I purchased 100 shares as a swing trade. And at this point, I was up 13%. So I left the 13 shares in the stock as free money, and I took back my 87 shares, right? So now I got free money, okay? So it broke. Well, here is the interesting thing. So that was my first swing trade, 13 shares back in it. So if I fast forward, the interesting thing is the very next day, I got a massive reversing candle. Okay? To me, that's another buy signal right there. You have this huge, huge volume bar closed back above the 50-day moving average. So I said, okay, I'm going to buy some more. I ended up buying 150 shares, although in hindsight, you know, I probably should just stick to a simple, you know, 100 share algorithm or something like that. That way I am, you know, not making emotional decisions on how much I need to be buying based on the setups that I like, right? Take the emotions out. Okay, so I bought 150 shares. Well, you know, this was my mistake, and I made the mistake. So I sold. I was up about 5% right here. It looked like it was going to crack. but it was also right before earnings too. So I went ahead and booked my profits. It was like 5%. It ended up being 7 shares. So I sold 143 shares after buying 150. So I reinvested 7 shares back in it. So on this swing trade, I paid myself 13 shares in dividends, if you want to look at it like that. And on this trade, I paid myself 7 shares in dividends. So right now, or it might have been 8. So right now I'm up, 20, 21 shares. Okay. Well, my mistake was I should have stuck to a very simple rule on the second swing trade, like let it break the 50-day moving average like I did the first one, right? Like I had a simple rule my first one. This one, we were coming out of a bear market. I could have swore the market was going to roll back over. I sold early, gap up on earnings the next day. That cost me. So if I would have stuck to, so this is where my feelings got in the way. And even though I would have gotten out, up here, I probably would have, made an extra 5, 10 shares, because this blue line is the 50-day moving average. So then it broke, okay? So this is where I should have gotten out on this gap down day. Instead, I got out here, right? So even though that's an ugly gap down, I would have made more if I would have stuck to a simple rule set. So the concept is very, very simple. You pick a stock that you like, not I like, you like, and that you think has pretty good growth potential over the next 10 years. Not the next 3 to 5, over the next 10, 15 years, right? You have a simple concept on why you think it could do very well. And then you swing trade around your core position and you reinvest your gains, call it your dividends, back in. So at this point in time, I bought 175 shares, and I think I did the math wrong. I actually swing traded 21 shares. So if I can do some quick math, I just paid myself a 12% dividend reinvested off swing trading around my core position twice. Okay. So now let's move on. Okay. So now here's where we're at year to date. Did I know this was going to absolutely take off? Absolutely not, right? And actually, I made an even bigger mistake. I had an earnings right here this day. Okay? So I had an earnings report on May 15th, and I blinked and I said, let me see where it, because right at the 200-day moving average, and I said, let me see where it's at the end of the day. At the end of the day, I realized my stop loss would have had to been greater than 10%, right? So I passed, right? I did not buy an additional 100 shares, and this would have been the signal bar I should have bought it at. Should have bought it at right here. I didn't. I passed. This mistake cost me 77 shares because, from this point where I could have got in, the stock went straight up 77%. So I could have bought 100 shares. And I, basically, I could have reinvested 77 back in it, right? Or approximately. So I could have made about $1,500 off a $2,600 investment, 100 shares at $26, roundabout, approximately, and that was the mistake I made. The reason sometimes that does cost me. I like to have a rule where a lot of times I like to wait to the end of the day to make my decision. Sometimes strong stocks get stronger and then my risk model goes off and I don't want to risk more than, 10% or whatever on a swing trade. Absolutely took off. So I know this looks like a rosy picture, but if I go back to the original chart and, where I was in right here, and then all of a sudden, my average price per share was 29. It got cut down to 17. That is a hard thing to sit through unless you have an amount in it, that you're not emotional about. That's why that's where the swing trading over the long term really comes in. If you start with an amount you're not emotional about, then you can start to swing trade around your position and really, really get that back. Okay. So let's look at some quick math. So average price per share at 29 originally. Now it's at 46. I'm doing pretty good on this one. So let's look at a math example, and I'm showing you this strategy, one, to show you a real life case study, a real life example of what I did, and two, maybe I can inspire you. Maybe you have some long-term investments, you swing trade around them. If you make money, you reinvest the shares back in the stock, and that will work especially well if it's a dividend payer. Then you can compound that. If you lose on the trade, you let the cash in your account take the loss, not the stock, right? So, for example, I've invested around $5,000, right? That was my total initial investment right here. That's not a lot that's going to get me emotional if this stock just totally hits the crapper, which it could, right? On this assumption right here, I'm just running a 15-year math. So I've swing traded an extra 21 shares. I've been doing this 11 months. I've only taken 2 trades. Okay. You don't need to do it a lot, by the way. I've only taken 2 trades, and that yielded me an extra 21 shares. So now I have 196 shares, right? So at the end of year 1, I have 196 shares, and this is the price per share as of yesterday, around 46 bucks. So the total value of about $9,000, right? So started with about 5,000, ended with about 9,000. That's looking pretty good right there. But, it's not going to do that. It could be down 20% next year. So, but I just ran a simple calculation and said, okay, what if this is just year 1. This is year 1 right here. Okay. This is year 1 of the case study. And I said, okay, what if keep in mind, I made a huge mistake not swing trading a third time right here. I could have had a lot more. But say, okay, what if I can just swing trade an extra 21 shares per year, right? And this just, single position. And with the price per share going up only 8% per year. So if you're adding an extra 21 shares a year and your price per share is going up 8% per year, I mean, if that math holds true, start with around $5,121, after 15 years, you could have $66,000 in this one stock. So if you take, I could do it. That's just to show you the power of swing trading these shares. Now, what if I just say, okay, remember this, 21 shares, 8% per year after 15 years, 66,000. What if I don't swing trade, right? That will only so what if I keep the same 196 shares? That will only compound to about $26,000, which is still pretty good on a $5,000 investment. If all you got to do is average 8% per year, but if I swing trade an extra 21 shares, I add an extra $40,000. Right now, this is a very, very long-term strategy. You can have 2-3 years of a stock you really like, just really hit the tank. You can have, you can lose on your swing trades, right? Like, obviously anything can happen. I'm only showing you what I've done so far to show you what's possible and then run the math out. You could get 5 years in and then all of a sudden the reason you like that long-term stock changes, right? So I think you could do this with 2 or 3 stocks that you think have 15-year potential, just massive overhaul potential. I just want to show you what's possible mathematically. Simple math, simple conservative math, if you could swing trade around core positions. And again, I please don't go out and use this stock as your long-term idea. I prefer you to pick your own. I wanted to give you a real life, no BS example. So I said, okay, what if you started, right, with $3,000? What if you went out there and said, okay, I got a $10,000 account. I'm going to start $3,000, right? Or I'm going to start with Amazon or whatever the case is. Something you can see just dominating for the next 15 years. So let's just make some very, very simple assumptions. $3,000 account. You start with 100 shares, and I'm just using simple math. That's at $30 per share. Okay. Let's say you do three swing trades per year. Swing trade 1 gets you an extra 10 shares. Swing trade 2 gets you an extra 15. But then swing trade 3 loses you 10 shares, right? Now here's the actual thing. Keep in mind that when you lose, you're not going to take the money out of the stock. You're going to let the cash in the account pay for the loss. So even though you lose, you're still, even though you lose on a swing trade, you're still going to reinvest the 25. Okay. But let's just say, I know that might be, so let's just say you're only reinvesting 15 shares per year. So at the end of year one, whatever stock you have 125 shares. So, or excuse me, I should say 125. Let's just say 115. Okay, whoops. So let's just keep it simple. All right, whatever scenario you have, let's just say you're only reinvesting 15 shares per year. So at the end of year one, you have 115 shares of XYZ stock, and you've returned 8% for the year on the shares. Some years it's going to be double. Some years it's going to be minus 50. Some years it's going to be up 10, 5. I don't know. There's no way. I don't have a Monte Carlo simulator, but let's just keep it simple. So at the end of year one, right, if you swing trade 15 shares plus you get 8% on the price per share, your $3,000 is now, up $3,726, which actually, if you kind of 3,726 divided by 3,000, it's actually 24%, 24.2% that you made on your shares, okay? So then you do that every year. You swing trade an extra 15 shares. So by the end of 15 years, you have 325 shares. You're getting 8% per year. Very simple. $30,000 or $31,000. $30,920.65. So, you start with 3,000. You swing trade 15 shares a year. You get 8% per year, right? Which is, I hope you get that. That's tenfold your money in 15 years. So it's a very, very simple, and I really like to look at it as dividends. I'm paying myself dividends. I'm reinvesting dividends by swing trading around my core position. Very, very simple concept, right? But I think what is the hardest concept with absolutely any strategy, I had to yawn, any strategy you do, the hardest concept is sticking with it, right? So that's why I think going back to the only way you're going to stick with a long-term strategy is to sometimes start with an amount that's not, you're not gonna cry about it if something bad happens, right? But can you imagine? And obviously Warren Buffett is his own man, but if you have a Warren Buffett strategy where you have a hold forever, and then you had an extra 15 shares a year in dividends just because you're swing trading around it, and that's only if that's if you lose one and all that other stuff. I think you can do very well. So I think this is a wonderful strategy. I think this is something I've never seen anybody else talk about. That doesn't mean other people don't do it, but I really came up with the idea about a year ago, especially after I had a couple long-term stocks, that hit the bear market. Then I was like, how can I mitigate this downside? Well, reinvesting my gains and just letting that run. Okay. So I hope this was helpful. I hope this was eye-opening. I want to share with you my wins. I also want to share with you my mistakes too, so you can look at it and say, okay, at the end of the day, we're trying to come up with really good ideas, but it's more important to limit your mistakes, because your mistakes are going to cost you more money than your wins are probably going to make you. Because if you limit your mistakes, your wins are going to be big. If you stick with the strategy over a year, 2, 3, whatever the case is. So I hope you let me know if you have any questions.